Good morning and Happy New Year. I'm Larry J. Ripka, CEO of the Valmark Financial Group. This morning, I'd like to talk about new whole life products for 2022 and the dividend scale. In the fourth quarter of last year, the big four mutual life insurance companies, Northwestern Mutual, New York Life, Mass Mutual, and Guardian, announced both new products and their 2022 dividend scale for both new and existing products. To the surprise of many, the dividend scale remained unchanged from 2021. This has prompted at least a dozen conversations and email chains with member firms in recent weeks. The basic question we're asking, how is this possible in the face of dramatically lower bond yields that seem to have impacted all other financial products? And perhaps more importantly, is this sustainable as we evaluate whole life products? Switching metaphors, is this new whole life recipe really the same, or is it more breading and less meat? First, let's review the basics on whole life products. Whole life is the oldest form of life insurance. Developed in the 1830s, it offers a fixed premium based on conservative assumptions. Whole life products are designed so that the guaranteed cash value equals the policy's death benefit at policy maturity. To the extent that the company does better than these assumptions, it pays a refund to the policyholders called a dividend. Now, dividends can be used a number of ways, but they're usually accumulated in the policy's cash value or sometimes used to reduce premium. The stated dividend scale for mutual companies today are between 5 and 6%, far higher than the new bonds that they're bringing into their portfolios. This doesn't mean that the cash value earned is 5 or 6%, but only that the interest component, along with other elements, including mortality, loading, and other expenses, are based on this rate. Today, these four large mutual companies sell virtually all the whole life in the United States. These mutual companies have continued to sell whole life, the same product that they were selling 150 years ago. If we look at their sales in last year, this type of product represents the majority of sales for all four of these companies. Yes, there might be something else on the menu at these mutual companies, in the same way there might be something other than chicken on the menu at KFC, but it's not ordered often, and the franchise is dependent on chicken, not salads. So, why is it such a surprise that these companies held their dividend scale for 2022? It's because all the bonds they are bringing into their portfolio are yielding much less than they did a couple of years ago. In fact, 89% of the general account assets of the top 100 companies are invested in bonds, mortgages, policy loans, and cash equivalents. Logic would lead to the conclusion that the dividend must fall as lower rates on these instruments pull down overall return. Every other financial instrument is experiencing lower rates, whether it's CDs, money markets, bond funds, and annuity payouts from these exact same insurance companies. It's precisely because most of the general account assets are invested in bonds that there's always been a relationship between bond yields and dividend scales. See this chart going back more than a dozen years. As bond yields have dropped from the double-digit rates in the early 90s, so have the dividends. But this brings us back to the question, why do we not see that relationship for these big four mutuals in 2022? Bobby Samuelson, the editor of the Life Product Review, took up the same question in a post entitled, "The Unstoppable Force Meets the Immovable Object." In the post, the drop in bond yields is the unstoppable force, and the seeming unmovable object is whole life dividend scales for these mutuals. The post suggests the suspension of this relationship could be attributable to several factors. First, Mutual companies are owned by policyholders and don't upstream the profits from the products to shareholders. Second, these companies can use existing surplus and unrealized gains to temporarily hold their dividend scales. Finally, he suggested mutual companies may use profits from other things they own to subsidize the dividends on whole life products. I think these first two reasons are valid, but I really disagree with this third point, and even if you agreed with it, it's a small component. First, if less than 10% of the assets are invested in things other than bonds and mortgages, even outstanding performance can't really move the needle much. If we grant credit for all three of these factors and say that you could boost bond yields by an additional 50 basis points over 3.5%, it still shouldn't account for this drop in dividend. J.P. Morgan was once quoted as saying, "A man has two reasons for what he does, a good reason and the real reason." We've been hearing some good reasons why the dividend scale hasn't dropped, but I suspect the real reason is that 2022 is also a year where whole life products are all changing. And to mask some of these changes, the companies have held the dividend scale. The NAIC is going to require that all companies, including these mutuals, lower the standard non-forfeiture rates in the products that they produce. They are dropping them from what had previously been 4%, and they are now required to move them to no less than 2, but no higher than 3.75. So this means every company is refiling its product with lower guarantees. So while they could have dropped the guarantees on their new whole life products to 3.75, most of these same companies have dropped it to 3%. So if ever there was a time when insurance companies wanted to hold their dividend scale, it would be this year. Imagine what would happen if one of these companies dropped its dividend scale while the other three held steady. These companies do have very strong balance sheet and sufficient capital to subsidize this dividend for a short period of time. Over the last 2 years, all 4 of these companies have sold business units and issued surplus notes that have allowed them to make these payments to policyholders for a short period of time without threats to their ratings. So, how does this all impact an insurance recommendation? I think it really comes down to suitability. Whole life has its place with the right clients. All 4 of these companies are excellent insurance companies and offer some of the best whole life products in the marketplace. In fact, if I were to buy a whole life policy for myself, I wouldn't buy it from any company other than these 4. If your client's ordering fried chicken, get it from KFC. For clients that are heavily invested in CDs, government bonds, AAA bonds, whole life is the product of choice. Dividends will continue to fall in line with the yields on the bonds that back them. This means looking at whole life products with illustration rates at closer to 4 or 4.5% at most. The reformulated whole life recipe for 2022 is still tasty, but includes more breading and less chicken. For several years now, Valmark has been publishing an annual dividend scale white paper that looks at whole life in depth. If you would like a copy of this paper, you can request one from Brandy Free at the email address below. Thanks for listening today. At Valmark Financial, we bring the golden rule to life.